Hey everyone, and welcome to The Explainer. Today we're unlocking the vault on what is easily one of the most powerful but honestly wildly misunderstood strategies in the entire financial world. If you've ever found yourself wondering how the truly wealthy manage to patiently build absolute fortunes over time, well, you are in exactly the right place. We're going to decode the secret mathematical and psychological engines of wealth building, dividends and drips. By the time we wrap up this explainer, you're going to see exactly how setting up automated systems, combined with just a little bit of human psychology, can completely transform your financial trajectory. Let's get into it.
Okay, I want to start by looking at a truly staggering number, 285,436. What if I told you that since 1871, the S&P 500 didn't just grow a few hundred times over, but actually grew by a multiplier of 285,436? Well, that is the exact multiplier you get when you factor in the magic of dividend reinvestment. Think about that for a second. If you had just left your money in the market without reinvesting those dividends, your wealth would have only increased 460-fold. I mean, that's literally the difference between an okay retirement and generational wealth. It just absolutely proves that dividends aren't some nice little bonus payout on the side. They are the actual engine room of long-term market returns.
So this brings us to a really fundamental crossroad, right? It's the core conflict that every single investor has to face at some point. Do you want income right now, or do you want growth over time? I know it is incredibly tempting to chase the immediate gratification of a high yield. Getting a fat cash payout today just feels like a huge win. But as we just saw with that massive historical multiplier, choosing to pocket the cash today instead of letting it compound, well, that might just end up being the most expensive mistake you ever make.
All right, let's jump straight into Section 1, the strategy, high yield versus dividend growth.
Let's break down this fork in the road using some really fascinating insights from ProShares. You can see how sharply these two strategies contrast. On one side, you have high dividend yield. And sure, it gives you immediate income. But here's the catch. To keep making those massive payouts, companies usually have to sacrifice reinvesting back into their own business, which basically chokes off their future growth. Plus, they're super vulnerable to changing interest rates. But then, on the flip side, we have dividend growth. Strategies that track things like the S&P 500 Dividend Aristocrats focus on high-quality companies that have consistently grown their dividends for at least 25 consecutive years. It's an all-weather approach. It's the quintessential inflation hedge, and it just gives you a much better balance of total returns, completely regardless of which way the wind is blowing on interest rates.
Which brings us to Section 2, the engine of wealth, drips.
So, if dividend growth is our ideal vehicle, how do we actually put the pedal to the metal? We do it by understanding exactly what a DRIP is. It stands for Dividend Reinvestment Plan. Instead of letting your dividend cash just sit there idly in your brokerage account doing absolutely nothing, a DRIP automatically takes that cash and buys more shares of the company, often right down to the literal fraction of a share. Your money is being put to work instantly and constantly. You're buying more shares, which then pay you more dividends, which then buy you even more shares. It is the ultimate financial snowball effect. And just to show you how massive that snowball can actually get, let's look at this incredible example from the IISE blog involving Enterprise Products Partners. Get this, some companies actually offer a discount when you reinvest your dividends through a DRIP. In this specific case, it's a 5% discount. If you invested just $100 a month into non-discounted units, after 50 years you'd have a very respectable $2.3 million. Never to sneeze at, right? But check out the math when you utilize a DRIP with that 5% discount on reinvested shares. That exact same $100 a month mathematically explodes into over $15.6 million. No joke. That is the astonishing reality of compounded, discounted dividend growth over time.
All right, moving on to Section 3, the human element, psychology and automation.
Now, as any seasoned investor will tell you, math is really only half the battle, right? The rest of it takes place entirely inside our heads. We've got to channel the Oracle of Omaha himself here. Warren Buffett famously said, "The stock market is designed to transfer money from the active to the patient." I mean, that just perfectly captures the whole concept of time arbitrage. Patience absolutely crushes the frantic, highly emotional buying and selling of market timers. When you automate your wealth with a DRIP, you're literally forcing yourself to be that patient investor who's on the receiving end of that massive wealth transfer.
And listen, if you're ever tempted to actively trade your way to the top, you really need to look at the staggering odds against market timing. Studies show you'd need to be right 70 to 85% of the time just to match the market. Just to match it. And even the greatest investors in history barely crack 60%. Look at the real-world impact of missing just a few days. Between 1993 and 2013, if you missed just the top 40 days in the market, your overall return dropped to a negative 1.02%. Think about that. You'd actually lose money. And here is the wildest part of all. Those absolute best portfolio-making days, they almost always happen right in the middle of terrifying economic crashes, which is exactly when every human instinct in your body is screaming at you to sell everything.
You know, there's an old Wall Street saying, stocks rise on an escalator, but drop in an elevator. This highlights a very real, very powerful psychological force called loss aversion. Basically, it hurts twice as much to lose a dollar as it feels good to gain one. So when the market drops in an elevator, the psychological pain immediately triggers panic selling. But here is the true beauty of a drip. It acts as this mechanical, emotional guardrail. Because it uses automated dollar cost averaging, a drip forces you to buy more shares when prices are at their absolute lowest and yields are at their highest. It completely overrides your panicked human instincts.
Let's head into Section 4, the guardrails. Beware the hidden costs.
Now, before we get completely carried away with how awesome automation is, we do need a reality check. We have to talk about the dark side of drips. Because not all drips are created equal, and fees can be an absolute silent killer for your portfolio. If you dig into the actual plan documents for companies like Walmart and IBM, you'll see what I mean. For instance, Walmart hits you with a $20 initial setup fee, plus purchase processing fees, plus sales fees. And IBM? They require a minimum one-time purchase of $500 just to get your foot in the door. If you're trying to invest smaller amounts over time, these setup fees and minimums will quietly and aggressively eat away at your compounding returns if you aren't reading the fine print.
And that brings us to Section 5, avoiding dividend traps.
So, we know how to navigate the fees, but there is one final major risk on our roadmap today. It's the dreaded dividend trap. Let me be super clear. A high yield absolutely does not mean a safe yield. Data from Simply Safe Dividends acts as a massive wake-up call here. They found a huge cluster of massive dividend cuts coming from companies that had a safety score below 40. We're talking about massive, well-known companies like Kinder Morgan and ConocoPhillips. Reinvesting your hard-earned dividends back into companies with risky, unstable business models is incredibly dangerous. Instead of compounding your wealth, you are just throwing good money after bad right before they slash their payouts. It is absolutely crucial that you stick to high-quality companies with proven, solid safety scores.
Which brings us to our final question for you to chew on today. Are you actively trading your way out of wealth, just frantically trying to time an entirely unpredictable market? Or are you patiently compounding it? Because if you focus on consistent dividend growth, set up low-fee DRPs to put your reinvestment on autopilot, and carefully avoid those high-yield traps, you completely remove the emotional errors that destroy most people's portfolios. Let the automated, relentless power of dividend growth build your wealth in the background while you actually go out and live your life. Thanks so much for joining me for this explainer, and I really hope this roadmap helps you build the exact financial future you're aiming for.